right, welcome everyone. We're going to allow all of our participants to join us here in the room. Please find a comfortable seat. If you don't find the chair that you're sitting in comfortable, that's your own fault because you're in your own homes, cars, or wherever you might find yourself today. I'm going to allow folks to join us to file in here, and we'll get started in just a minute or two. And I see as we wait, folks are filing in. This particular session that you're tuning in for is recipes for tax-savvy giving with year-end considerations. That's kind of my shorthand version of this webinar. If this is not the ride that you're hoping to be on, you have two options. You can stay and find out about tax-savvy recipes for year-end giving, or you can leave. I hope you'll stay. And we're really happy to have you here today. And it's fun as I'm reviewing the list of attendees. It's fun to see so many great friends of PLU and of the firm Financial Insights, which I will introduce in just a second. We are happy to have you all here with us today. Doug, Karin, I think we should get started if that's all right with you. It's about a minute after noon. So just a couple housekeeping issues for all of you joining us from wherever you are. This Zoom webinar is being recorded, and so we'll be happy to share this recording with all of you as a follow-up in an email after our time together today. You are automatically muted. We can't see you, so whatever you're wearing and however you feel right now, know that you are safe and comfortable. This is a safe place for you. If you haven't been on one of these before, I'll just familiarize you with a couple of things, specifically the Q&A feature. If you look at the bar on the bottom of your screen, there's a question and answer feature there. We received several questions ahead of time, and we'll seek to answer those questions throughout our brief presentation as an introduction, and then we are saving the majority of our time at the end for your questions. So please utilize that function throughout. I'll be moderating questions. My name is Dan Lee, Vice President for University Relations here at PLU. I'm kind of your tour guide on this 1-hour tour. And so please type those questions in there. They are not public for everyone. They're sent to the 4 of us. And so there'll be no attribution. And that's an important part of our time here together today as a couple ground rules. Our focus is for this to be informative, for you to feel better informed, better equipped leaving this webinar. To achieve that, we're going to do a few things. One, there are no stupid questions. Often in philanthropy and in financial planning, we hear from the folks that we work with, oh, this is probably a stupid question, or oh, I'm not sure I should ask this. And today we're going to tackle this head on by talking about 3 things you're never supposed to talk about, that no one talks about. We're going to talk about money, we're going to talk about taxes, and we're going to talk about philanthropy. And we're going to try to do that in a way that demystifies those topics and that allows you to get answers to the questions that you need to have answered. A couple other housekeeping topics. I'm going to be the acronym police for our time together today. So I have 3 very smart panelists with me, all of whom often will use acronyms to shorten the language that they're using. And I'm going to try to stop them from doing that at least the first time that an acronym is used. We'll define each of those, and then we might move back into acronyms, and I might stop once in a while and remind us all what we mean by a QCD, just as an example. That'll be one acronym we'll define later. The last piece of housekeeping, I mentioned this already, there'll be a follow-up email following this presentation, this panel conversation today. That will include a recording of our time together. It will also include contact information for all of the panelists, so that if you want to have a follow-up conversation with any of us, you're welcome to do that at that time. So that's just some brief housekeeping, and I see a few other folks have joined us. So now it would be a good time for me to introduce our 3 esteemed panelists. I'm going to start first with Allie Chris, who is in the lower left-hand corner of my screen in the yellow blazer. Allie is president and managing partner at Financial Insights. Financial Insights is a comprehensive financial planning and investment management firm. They are an independently owned, woman-owned business here in downtown Tacoma since 1981. And they are on the 6th floor of the historic Carlson Hotel, if you ever want to visit them post-COVID. Allie is a certified financial planner and is a proud PLU alum. And Allie is a frequent speaker on topics we'll be discussing today. She is a member of Rotary 8 and has spoken at South Sound Plan Giving Council. And so, Allie, we are thrilled to have you with us here, and thank you for saying yes. My other two esteemed colleagues are on this call. Karen Austin is Director of Gift Planning at PLU. Karen is about to celebrate her 10th year of service at PLU here at the end of November. She's a graduate of both PLU and of Gonzaga Law School, and she brings her expertise to gift planning, working with estate gifts, more complex kind of giving, and answering just donor questions about the kind of impact they want to have. My other colleague on the call is Doug Page. Doug is in his 22nd year at PLU. He is our Executive Director of Gift Planning. Doug lives in beautiful Gig Harbor, Washington. He's the parent of two proud PLU alums, and he and his spouse, Kristen, who's a third grade teacher in Gig Harbor, are good friends of the university. Even though neither of them went to PLU, they really have made PLU their home over the last few decades, and we're thrilled that Doug's with us. And many of you on the call know that Doug is the master of gift planning at PLU. If there's an obscure tax code that you want to know about, Doug is the person to help you with that. So part of our goal is to keep Doug kind of in the center lane here and to make sure that all the topics are kind of understandable for whatever expertise you're bringing to the table here together. All right, so that's our introduction. As I said in the beginning, our topic for today is tax-savvy giving recipes, especially with a focus on year end. And to do that, we're going to talk about 3 different acts that were passed by the US Congress legislature in the last 4 years or so. Each of them have different implications for you in terms of your planning, in terms of kind of retirement planning and philanthropy. And so I'm going to ask each of the panelists to just highlight the high-level implications of each of these 3. That's our first step. We'll talk about some scenarios, things you might want to consider. And then we're going to save the balance of our time for question and answer at the end to make sure we're addressing all of your questions. Colleagues, did I miss anything in my introduction? Is that, we're good?
I think we're good. Just to mention that we did promise recipes. So those Thanksgiving recipes from the PLU kitchen, and then each of us has a favorite recipe as well that we will be sharing in that follow-up email. So
this is traditional PLU. We like a good pun, and then we actually deliver on the promise of the pun in more than one way. So that's what we're doing here together.
Exactly.
So let's kick things off, I think, with the Tax Cuts and Jobs Act. Doug Page, I think you're going to do an overview of this act.
Yes, Dan, thank you very much. Hello, everybody. In chronological order, the Tax Cuts and Jobs Act of 2017. This act substantially increased the standard deduction for both individual and married taxpayers, and it also limited some itemized deductions. For example, state and local taxes, put a cap on mortgage deductions. And this meant that many taxpayers who previously itemized now find it more advantageous to claim a standard income tax deduction, and because of this had no marginal tax incentive to make charitable contributions. Charitable organizations such as PLU and others have been concerned that this change, which eliminates the tax incentive to make a charitable gift for many people, will lead to a decrease in the amount of charitable contributions. Well, the good news is that over these past 2 years, there was no evidence of any kind of a decrease in charitable giving. And of course, that suggests what we all know, and that is that people don't give primarily or solely for tax purposes. However, there is one tax savings charitable strategy or recipe that a few donors with whom I work have utilized, and it's called charitable bunching. So I'll explain. A donor who in a normal year, even though they give to PLU, to their church, and to other charities each year, can only claim the standard deduction because they just can't reach that level of $24,000+ as a couple. So what they would do instead of, is that in that year, in a year, they would bunch maybe 3 or 4 or 5 years worth of charitable giving. So that requires that they have some resources to do that, but they would bunch 3 or 4 or 5 years worth of charitable giving in a single year, transfer cash or appreciated stock to a donor advised fund, and then make annual grants each year from the donor advised fund to PLU and to their church and to the other charities. By doing this, they have enough in that year, enough charitable deductions in that year to exceed the standard deduction and therefore see a tax benefit from making these gifts to charity. So it's a creative way to still benefit from a tax perspective for charitable gifts. It does involve using a donor advised fund, which isn't necessarily an easy thing or maybe even something you want to do. But I'm wondering, Allie, if you, as a financial planning professional, are you seeing people in your practice exercise this option?
Donor advised fund. Yes, I do present the donor advised fund as a bunching tax savings strategy. Some of my clients have chosen to go that route. Some of the reasons they like it, if they have children that are going to inherit the rights to manage the donor advised fund, it kind of in a way forces the children to continue the charitable legacy of the parent, and the children then also give from that account. That would be a benefit. Some of the reasons that my clients have chosen not to do them, even when presented with the tax savings, is some of the clients really like the annual gifting and the contact they have with the organization, and they like doing outright gifts annually. Also, if they become aware of some of the overhead fees associated with some of the donor advised funds, they don't like the way that it might erode away from the net gift to the charity. So there are some pros and cons I've noticed in doing them.
Okay, thanks. Yeah.
Mm-hmm.
Maybe just as a baseline too, I saw a question fly in here in terms of a donor advised fund. Can Allie or Doug, who wants to give a basic definition of what a donor advised fund is and how it shows up as one possible giving tool for people?
Yeah, I'd be happy to do that, Allie. You can correct me where I'm wrong. Donor advised funds are available at large financial houses, Fidelity, Charles Schwab. They're also available at community foundations, Greater Tacoma Community Foundation. And it's basically a fund that you establish at these places and you add assets into them. By doing that, by the way, the fund is a 501c3 organization, so it's a charitable organization. Fidelity's is called the Fidelity Charitable Gift Fund. And by doing that, the IRS allows you to take an income tax deduction. It's pretty flexible. There are some benefits. While it's in the Fidelity Fund, for example, it's invested, so maybe it'll grow, maybe it won't. There are fees. That's the negative side of it. Also, the IRS has not stipulated that donors make payments. They're not required to make payments out of those donor advised funds. So this is something that I hope will change, because you hate to see money that's sitting in a charity not being used for the charitable purpose for which it's intended. So, so I think that's, again, fees, expenses, management. Some of it is, some of them are very simple and some of them are a little more complex. Some of them require or have a definite end date. Maybe it's just for the donor's lifetime. Some would say you can add a successor grantee to that.
Allie, anything you want to, Doug isn't always correct. He's correct about 95% of the time, but I want to make sure.
Most all the time.
Anything you want to reframe there or make sure we're nuancing differently?
No, I think that was a fantastic representation of that.
Okay. Lauren, yep.
Can I add one thing about bunching? I think a donor advised fund is a really great opportunity for bunching if a donor knows there's going to be a variety of charities they want to support in the coming years, but maybe aren't entirely certain which ones those are yet. You can still bunch and give directly to charities. So let's say a donor knows that they're going to be supporting the Humane Society, their church, and PLU in the coming 5 years. They could make all of those donations that they would make in the next 5 years this year directly to the charity itself, if a donor advised fund isn't appealing. And
they could instruct the charity just to say, this is my for example, at PLU Q Club, people give every year to the Q Club. I have donors who said that I'm going to give you 3 years worth of Q Club gifts in this year. So just know that you won't be getting any more for the next couple of years.
I think the only other thing to add here is I think several of us have seen this with donors who perhaps work in the tech industry or other industries in which they might receive a large payout of securities or cash in a particular year, a bonus, for example, and they don't want to receive all of those dollars in a particular year. And they also, to Karen's point, want to spread their giving out over many years. So then utilizing a donor advised fund might be a good alternative. So, anything we want to add here on the Tax Cuts and Jobs Act before we move chronologically forward in time?
The only other thing that really came out of the TCJA, thank you, was that, and you'll learn more about this in a minute, but it did provide donors who contribute cash to charity the ability to deduct up to 60% of their adjusted gross income. And you're going to learn more about that in a second, but that's the other significant thing that happened in the Tax Cuts and Jobs Act that affects charities, charitable giving.
Thank you, Doug. And for all of our guests joining us, as a reminder, the Q&A function down in the lower right-hand corner, as questions come up or as our panelists are discussing things, if something's unclear, if there's any question you have, there are no stupid questions. Just throw that in there. Your question's anonymous except to the panelists. And I'll make sure we incorporate those in our conversation today. We're going to move forward to the Secure Act, and Allie, I think, is going to do our overview of this one.
Yeah, hi, thanks, Dan. I'm happy to be here today. So the Secure Act acronym is setting up every community for retirement enhancement. That's quite a mouthful. It was a bipartisan bill, and it became law in December of 2019. 2 main charitable related changes coming out of the Secure Act that will impact our donors. One is required minimum distribution changes. And for those that do not know what a required minimum distribution, sometimes shortened to RMD, is, tax law requires you to start taking money from your traditional IRA or your employer-sponsored plan pre-Secure Act at age 70 and a half. The Secure Act changed that minimum age to age 72. Why that's important for charitable giving is that's kind of correlated to what is called a qualified charitable distribution. And for those of you that do not know what that is, that's the ability for you to donate directly from your IRA to a qualified charity and not have any tax implication of doing so. So a lot of my donors may make a portion or all of that required minimum distribution in the way of a QCD, or qualified charitable distribution, to their charities, therefore satisfying the required minimum distribution requirement and also not bringing income onto their tax return. Now that the required minimum distribution age has been raised to 72, it is important to know that the Secure Act preserved the QCD being able to be done at 70 and a half. So what I've seen is some misconception among my clients thinking that now that the RMD age is 72, that they can no longer do a QCD until 72, and that is not true. At age 70 and a half, you can give up to $100,000 from your IRA tax-free directly to a charity. So those would be the 2 main changes, is the QCD that now can stay at age 70 and a half, and the RMD requirement until 72. Now, I would give you a example of why I would still do, or a client could still do, a QCD prior to age 72. A qualified charitable distribution is not subject to itemized deduction limits. So with the doubling of the standard deduction, many of you may not itemize your charitable anymore. A QCD allows you to still get a tax benefit for giving to a charity. And it's not subject to any of the percentage limitations. So it has that $100,000. So it allows you to give more than you maybe could give based on the percentage limitations in a more outright gift. So the third thing that I think I'm going to bring up with the Secure Act, we all want to know how this bill was paid for. Obviously, There was a lot of savings here for donors, but the way this bill was paid for was they removed the stretch IRA provision. And what that means is pre-Secure Act, all of your beneficiaries could stretch their IRA that they received, their beneficiary IRA, they could stretch it out over their entire lifetime. They were required to take a beneficiary RMD, required minimum distribution, based on their life expectancy for their lifetime. Now, with the new bill, the bill requires all non-spouse beneficiaries to take out all their money by year 10. There is no longer an RMD requirement for that beneficiary, but they now are required to take it out in that shorter time frame, therefore bringing more money in to pay for the bill, because now the IRS is getting all their taxes within 10 years. What this does is you can have a huge taxable event in year 10 if you had named your sister or a child, for example, as a beneficiary. So what I'm seeing some clients do as an outcome of that is they might, if they had, let's say, 50% of a beneficiary going to their charity of choice and 50%, let's say, going to a child, they may make the charity 100% beneficiary on their IRA and then make their child a bigger beneficiary in a non-retirement asset, because the charity does not need to stretch that IRA out. They do not pay taxes, and they usually would take that as an outright immediate donation to themselves. Therefore, taking your sister or your daughter away from having that 10-year stretch provision. So for me, those are the three main things that came out of the Secure Act. I don't know if there's any questions, but that kind of summarizes, I think, what I needed to talk about in regards to Secure.
Let's, Allie, let's unpack a couple of those things and do some scenarios. Sure. And I'll look to Doug and Karin as well in terms of donors you've worked with who have thought about this. One question might be, just to unpack that, as we think about beneficiaries. So we're talking about, let's talk about a scenario in which an individual has a relatively large IRA, and they pass away, and the beneficiaries they've named are their two children. Okay, so in that scenario, what's the difference between how it was before, and you highlighted this a little bit, what's the experience for those two children now under the Secure Act, who just received, let's say they received $500,000 each, as an example?
Okay, so pre-Secure Act, each child would be given the option to create their own beneficiary IRA in lieu of 100% taxable event on the passing. So they would receive an IRA that would be called normally a beneficiary IRA. They would then be taking annual beneficiary required minimum distributions over their entire lifetime. That was pre-Secure Act. That's normally what I would have recommended the children to do versus taking a taxable event at the death. But now with the new Secure Act, instead of being able to stretch that out over their entire lifetime, it now needs to be distributed by year 10. So there's some unique planning opportunities there that advisors need to dig into in now creating tax strategies so that that child does not have to take out $500,000, but probably more with growth in the stock market in year 10. That would be an extreme tax situation in 10. And even with $500,000, even if you divide it by 10 and try to take it out each year, it is still quite a bit more sizable than it was when you were stretching it out over your lifetime.
Thank you for that, Allie. And that's when those distributions are taxed as ordinary income. Is that correct? It's not a
correct.
So whatever the ordinary income tax rate is at that point. Doug?
Correct, and given the change in the potential change in our tax law that's coming next year, I think that the tax rates will more than likely be increasing from what they are currently.
So Karin and Doug, do either of you have a story or an example in terms of, because generally speaking, I think we're aligned with what Allie said, that IRAs make, ideally, they're not a great asset to pass on to family because of this taxation issue, right? So that's one kind of general rule. If you have other assets in terms of thinking about charitable purposes, do either of you have a scenario that you've seen donors, kind of a scenario of how donors handled this, both considering these implications?
Yeah, if you don't mind, Karin, I'll, quick story about a donor I work with, and what I've proposed to this donor, and we are in the process of completing it, and that is, rather than name the children as the beneficiary of the IRA, he is going to name a charitable remainder trust as the beneficiary of the IRA, and the charitable remainder trust will have 2 income beneficiaries, and that'll be his 2 children. Now, we're not going to talk about charitable remainder trusts in detail right now, but basically it's a really wonderful opportunity to make a charitable gift while receiving some income for the rest of their lifetime. And by doing this, you in effect are able to stretch the IRA, because the payout rate is going to be probably 5%, and that's probably about what the inherited IRA would have paid out, about 5% a year, probably, and it'll increase, of course, as they get older. But in this case, it stays at 5%. It's taxable as ordinary income, but it lasts forever, and at the end of the lifetime, the gift will be used for PLUs, the purpose for which this donor wants to support PLU. So it's really a great thing.
Great. I've got 2 questions. Oh, Karin, do you want to jump in?
I was just going to add that Doug and I and all of the gift officers on our team always talk with folks we work with if they're working on their estate planning. If there's a will and a retirement account as a part of that estate plan, which most of us have both a will and a retirement account, we really encourage that charity is considered first and foremost in that retirement plan. And so because a couple of reasons, the tax benefits are just so high to leaving a retirement plan to charity, because charity doesn't have to pay those same income taxes that individuals do. And also it's easier to change. It's easier to change the beneficiary arrangement for your IRA than it is to change a will. Yeah.
I've got 2 questions that have come in. The first question, so Allie, based upon what you were sharing with the changes to IRA, does this impact a trust set up for a child with a disability, as an example, in terms of how the IRA funds are used?
I believe children with disabilities or beneficiaries with disabilities do not fall under the 10-year stretch provision rule. I believe that's one of the exceptions, along with a spouse.
Okay. Doug, Karin, Doug's nodding yes too. So yep. So spouses and a child with a disability, or a dependent with a disability, would not be required to take the distribution over 10 years. They could stretch it over.
No, but I would speak with your estate planning attorney, because there are some issues that we've encountered with having trust as written as a primary beneficiary in lieu of this act. And I think revisiting it with an attorney post-Secure Act, just to make sure that it's going to do what you think it's going to do, would be very important.
Yeah, I agree.
Good advice. The second question, given what you shared about the Secure Act and beneficiary IRAs, is it still possible for the recipient to defer some of that income over 10 years into a donor-advised fund or a charity?
Doug, you can take that, but my understanding is that you cannot put IRA money into a donor-advised fund at this time. They are trying to make those changes, I believe, legislation-wise, but I do not believe that is passed as yet.
Yeah, that's my understanding as well. And I kind of heard the question: can a son, for example, who receives a beneficiary IRA, can they avoid the taxes by themselves deferring it to the charity or to a donor advised fund? And no, once the beneficiary is established on that and that donor has deceased, that's locked in. So you cannot assign income to a charity.
Yeah, what you can do is take the offsetting charitable deduction, but you can't bypass the income.
Yeah, 2020 would be a good year to do that, but we'll talk about that in a minute.
I will also note there are some stretch IRA strategies. I'm not going to get into them here, but for 2 spouses that are living, there are some stretch IRA ways that you can maybe give 50% to your spouse and then some to your children, and then have the second spouse also give some to the children, therefore making the 10 years into 20. There are some kind of creative things you can do there. Again, I won't get into the details, but just know there's a couple things there that advisors are doing right now.
So a good note there about exploring ways in which you divide between the two. I think those are the questions we received so far. Let's move, Doug had a nice segue to move chronologically forward. We have one more act to cover, which is the CARES Act. And this one is most time bound, right? There are certain provisions here that are set to expire at the end of 2020. So Karen's going to talk about this one.
Yeah, so the CARES Act, this is the 2020 Coronavirus Aid, Relief, and Economic Security Act, which a lot of us, we've all probably heard about this in the news quite a bit. There were a lot of provisions as a part of the CARES Act. It was signed on March 27th, and it was to combat the far-reaching impacts of COVID-19. The only provisions we'll cover today are the provisions that are relevant to philanthropy and charitable planning, but there were a number of provisions that were essentially put in to help stimulate philanthropy and also to help give people some relief. So a couple of those, Doug mentioned this earlier and Ali did as well. There are what we call percentage limitations to what you can deduct as a charitable deduction. So these percentage limitations are based on your adjusted gross income or your AGI. And in the past, that has been for cash donations, you can take a deduction of 60% of your AGI. So what that looks like is if your AGI is $100,000, you after all is said and done, that number is 100, and you give $60,000 in a year, you can deduct the full 60,000. But if you give $80,000 in a year, you can deduct 60,000 this year, and then you can carry forward the 20,000 to deduct next year. This year, they have made a one-time change that taxpayers can deduct up to 100% of their AGI. So that means if your AGI is $100,000, you can deduct $100,000. This is a really great provision for folks who are wanting to make really large gifts, who are wanting to take large charitable deductions, or folks who are wanting to chip away at the value of their estate. So oftentimes people want to avoid estate taxes when it comes time for estate taxes, they want to avoid those. And so one of the ways that attorneys and financial planners will encourage them to do that is to start giving money away. But then there are limits to how much money you can give away. So there aren't those same limits this year. So that is something that is set to end by 2020. After in 2021, that will go back to 60%. Another thing that the CARES Act did is it gave what we call an above the line deduction. So an above the line deduction is something that every taxpayer gets, no matter whether they itemize or not. And there is an above the line charitable deduction this year for every tax return up to $300. So if you hear one thing today, I encourage everyone, if you're able, I know we're not all able this year, but if you are able, to give $300 to charity this year. This is the year to do it. Even if you don't itemize, you will be able to deduct that from your taxes. The final thing that affected charity from the CARES Act, Ali talked about required minimum distributions and their role in qualified charitable distributions. The CARES Act of 2020 gave what we've been calling the holiday, the RMD holiday. So anybody who is 72 and above does not need to take their required minimum distribution this year. So that is a relief for folks who don't want that additional income. They don't want to add that to their taxable income. As charities, we were a little worried. We were a little worried that not having that RMD wouldn't inspire people to make a QCD, the qualified charitable distribution, this year. In practice, we're not seeing that come to fruition as much. I will note, you can still do a qualified charitable distribution this year. Even though the required minimum distribution is not required, you can still do a QCD. In practice, we're seeing a few less, but really the folks who like to give in this way still like to give in this way. Ali mentioned there's tax advantages to it regardless of whether it's helping you towards your RMD or not. So I work with a donor who was going back and forth on this, worked with her financial planner, and they saw the positives and negatives. And so she called me and we talked it through, and she essentially decided that she was going to still make her QCD this year. Her reasoning being she wanted PLU to have the money this year, and this was a way that this is her best asset from which to give. And also, if she didn't give from this asset next year, her required minimum distribution next year would be that much higher because it's based on a percentage of what's in that account. So she's kind of chipping away at her retirement account through gifts to PLU. That is the CARES Act, primarily, I think. Did I miss anything, friends?
Allie, Doug, anything you want to add on the CARES Act at this point? Got a couple questions, Karin. So you mentioned, let's go back to one of the key provisions you mentioned, which is that a person can deduct up to 100% of their adjusted gross income this year, which is a one-time that's set to expire at the end of this year. Can they stretch that deduction out over multiple years? So if they don't need all of it this year, could they stretch it out over multiple years?
Yes and no. The 100% is just this year, but you can always roll over a deduction for up to 5 years. But in the following 5 years, that 60% will apply. So in my $100,000 AGI example, if somebody gave $200,000 to charity this year they could deduct 100. Next year they could deduct 60, and the year after they can deduct 40.
Okay. Doug, you want to jump in there?
Yeah, I just want to throw out this possible scenario, and that is that the 100% deduction is elective. So you have to choose to do that. And for some high income people out there, people who are itemizing on their tax return currently, it may actually make sense for them. It may be beneficial to them to, from a tax perspective, to make that gift and then to claim just the 60%, because next year they'll have more money that they can offset their income, in which they might be in a higher tax bracket. So it's one of those it's one of those CPA questions you should ask, whether it's good for you to do that now or wait a year. Yeah.
Mm-hmm.
What about this issue of, so if you choose not to make a required minimum distribution, RMD, this year, both, Karin's already mentioned that your IRA will continue to grow, right? And will be that much larger, so your RMD will be larger next year. I'll start with Allie. Are there other tax savvy ways that the clients are discussing making charitable distributions this year, or charitable gifts this year, given the RMD holiday? What are other ways as they kind of think about pros and cons here?
Sure. I have clients that sometimes even prefer to gift appreciated individual or stock securities or appreciated assets. A charity can sell an appreciated stock. For example, let's say you bought Boeing or you worked for Boeing and you've had it since the 90s and it's highly appreciated. If you were to sell it, you would owe capital gains tax, normally at the 15% capital gains rate currently. When you give that to a charity, the charity can sell that without paying capital gains taxes, and then you also receive a charitable deduction. So I see clients do that quite frequently. We facilitate those transfers. Something else to note that's correlated is with the potential change in tax law next year, there has been some discussion of increasing capital gains tax rates in various tax brackets. So 2020 may still be a good year to do that if you're falling under 15%, and maybe you would be going up to 20. So appreciated stock, to answer your question, Dan, is what I see most frequently outside of the IRA.
And go ahead, Karin, please.
I was just going to say, I think appreciated stock and IRA gifts fall into a similar category of it's oftentimes people's largest assets. So their stock portfolio and their retirement, their IRA are the largest assets, and they can be really incredible ways to give to charity.
So let's talk about these if we could. Doug, did you want to add something?
Well, I just have a quick story about this that I think might be applicable. I was working with a donor, and as that donor was about to write a large check, I asked them, I said, well, before you write that check, do you own any appreciated stock? And I knew the donor did, and he said, yes, and I do. I said, well, why don't you, instead of writing a check, why don't you just have the shares that are equivalent to the size of the check, make that gift to PLU, and then we will, you make the same gift size, amount of money that you give to PLU, you avoid that capital gains tax, and PLU benefits. And the donor said, but I love this stock. It's got so much going for it. I don't really want to get rid of it yet. And I said, well, this is great. You can take that $10,000 check. Oh, I gave it away. $10,000 check that you were about to write to me and just repurchase those shares right away. I mean, you can do this simultaneously. And they couldn't believe it. And that way, by doing that, they wash away the capital gains attributed to those shares of stock, so that they, in future years when they want to sell those stocks, the capital gains might not be as bad.
And that's if you're emotionally connected to your Apple stock, as an example, or something.
Exactly.
Right.
Okay. Everybody loves their Apple stock. You're right.
So let's just, if we could, just unpack both of these things just a little bit. The technical term is appreciated securities, but what might be an appreciated security? What would be a common nomenclature for things that have been appreciated that could qualify here? Like a mutual fund, as an example? Are there other names that we would commonly use if folks are unfamiliar with that concept?
Well, yeah, I mean, mutual funds generally by nature don't have as great an appreciation, because every year you get your 1099 and you pay capital gains tax, because the mutual fund is buying and selling constantly. Whenever it does, you're paying those capital gains taxes. But there are some that have appreciated very well. I would say, what we see the most are stocks, are corporate stocks. And it's a very simple process to transfer them in. To PLU, it's electronic. Most people hold their stocks in what's called street name. They don't physically have the securities in the bank like they used to. And one last thing I'll say about this, and that is, if there's some people out there that were smart enough to purchase Zoom stock before the pandemic, that because of the pandemic, Zoom stock has gone up in value quite a bit. You might say to yourself, I bought that Zoom stock. Maybe that'd be a good gift to give to my charity. The answer is no, it's not. I mean, it might be eventually, but right now it's not. And the reason is because you bought it in March, and you have to wait till it's long term, which is 12 months. So you would want to give that away after, whatever, in March, after a year after you've owned it. Why? Because it's considered. You don't get the benefit of the income tax deduction. Of the capital gain deduction by doing that. You have to recognize that it's a cost basis deduction, not a fair market value deduction.
Karin, and then I think Ali wants to add things on this one too. Yeah.
If we expand, go ahead, Ali.
No, Karin, you go. I was just going to say something about mutual funds. I really don't want to discourage people from gifting mutual funds. We have clients who've had mutual funds since the 90s. I can throw out, let's say you had American Funds Fundamental Investors you bought in 1995. I would consider it highly appreciated at this point, and I do see it gifted quite frequently. Not that particular mutual fund, but I just don't want to discourage people from looking at their mutual funds, because chances are you do have highly appreciated mutual funds as well.
Quick mutual fund note, if you do want to make a gift of a mutual fund, don't wait until 1 week before the new year. That's something that you should call your financial advisor sooner rather than later. It takes stock.
You might not have a financial advisor anymore.
Yeah, exactly.
The day before.
Yeah.
So this is actually this is where I wanted to go. Actually, was for
Yeah.
I experienced this in the last year with a donor that I worked with who had a mutual fund that he didn't really care about that much anymore. He and his spouse it was just sitting around. It wasn't a primary asset they were concerned about, and that was a way for them to make a large gift. In terms of for folks who have never done this before, both with gifting appreciated securities. And also, if you've never done a qualified charitable distribution, what does that process look like? How long does it take? What do they need to know going in? Karin, who wants to start on this one?
Yeah. We actually, PLU has an online portal that can help with both qualified charitable distribution gifts and with soon to be live a portal that will help with stock gifts. So the links to that will go out in our email after this, but essentially what this portal does is it allows you to put in all of your information, and it kind of spits out the document that you would need to give to someone like Ali. or to whoever holds your IRA, to the IRA administrator. Basically, each administrator for the QCD, for the Qualified Charitable Distribution, each administrator has their own form, their own process. Some are a lot easier than others. If you have a relationship with a financial advisor like Allie, the best thing to do is just call that person, and they can help walk you through it. Doug and I have both been on conference calls with advisors, walking them through it. So we are here to help in that way. With stocks, basically we give you our all of our information that you would need to know in order to transfer your stocks into our account. The biggest thing you don't want to do is you don't want to sell the stock and then give it. You want to gift the stock to the charity. So you need to know a couple of things from the charity, the DTC, the employer number, all of that. But we have all that we can share.
So, Karen, you mentioned an important thing, which is that if they were to actually sell those shares, they'll have to realize the capital gains tax, right? So you've lost the advantage. You do need to transfer them without selling.
Yes.
Allie, anything you'd add to that in terms of the process for folks considering either of those?
No, just the understanding, just to reiterate what you just said, the understanding that the IRA gift is direct. It's directly from the custodian that holds your IRA to the charity. The form gets processed, usually with your custodian or your financial advisor would create the form. Karen or whatever charity you're working with would give you the information that would be placed on that form, and normally a signature would allow that to go. But it is a direct digital transfer between the two institutions. It's not something that you go drop a check off somewhere. So that's sometimes a misconception. And same thing with the stock gift. It's very similar.
Mm-hmm.
And I think, so I think time is also an important piece, right? So I can say that sometimes in the cases of mutual funds or others, a special seal is required, or some sort of a medallion was actually issued in one case, and that from the bank, the banking institution, that can take time, right? So generally speaking, if you're going to do this, how much time should folks allow for this process to take?
Yeah, with stocks, I'd say, give yourself a couple of days. That one is the easiest of the three. With mutual funds, you want to give yourself, depending on the mutual fund, there are some cases that can be instances where mutual funds can be transferred fairly quickly, but plan on a couple of weeks minimum. Allie, do you think that's fair, or would you?
I would tell my clients to do it a month in advance at the end of the year.
Yep.
A few days, you might get disappointed if the transfer can't happen fast enough, which I actually have seen. I would say that's only if you're hitting up towards the end of the year. Yeah. If it's mid-year, then I think, a few days is great. But if you're trying to get this done before the end of 2020, a few days might give everyone a little bit of anxiety. A month is great. Start planning in November. It's even November now.
Now.
Look at that.
And then I'll just say the qualified charitable distribution from your IRA, for those of you that are 70 and a half and older, that should be a good couple of weeks as well, I think. Right, Karen? Yeah. And the other thing is, some of you may have a IRA checking account. And if you do, there's something just a little bit different that I want to bring up. And that is with the stocks, with cash, with all these normal types of gifts, it's called the Mailbox Rule. In other words, if you mail a check, it's not the date of the check, it's the postmark on the envelope that is the date of the gift. So if you write a check on the 31st, but it misses the mail and it comes in on the 1st, you just missed that month if you wanted to do it in the like December 31st. Stocks, it's the same thing. It's once it leaves your account. With QCDs, it's when it's cashed. So so you need to make sure that if you've got your own checking account, for example, it doesn't matter what the postmark on that account, on that envelope is. It's when the check is actually deposited. And luckily at PLU, we care about you, so we actually have folks working on New Year's Eve to make sure that all the checks that come in that are qualified charitable distributions do get put into the bank in time, so that we don't have any taxable events that the donors would not want.
But all of our all of our donors and all of Allie's clients always plan way ahead.
Way
I mean,
ahead.
there's, yeah, right. There's
Always.
certainly none of us would see an uptick in giving in December for any particular reason. As we are, we're nearing the end of our webinar today. We've got about 10 minutes left, and we want to make sure we address all of your questions. So we've done a good overview of these 3 acts. We've had some good questions already coming in. I've received a couple other questions that I'm going to ask our panelists, but as a reminder, if you have a question that we haven't addressed that's related to these, or maybe even tangentially connected, you know, I think whenever we have these conversations, it spurs something that might be related to estate planning or other pieces. Go ahead and throw that into the Q&A. We'll make sure we address your questions. Allie, I'm curious about Washington State in particular, and are there any particular considerations that residents of Washington should consider as we've discussed these three acts? And Doug, you can go after, or Karin after Allie if there's a follow-up there.
Okay, yeah, I would say absolutely. Something that everyone should know, Washington State has one of the highest estate tax in the country. Now, federal tax is different from state tax. Federal taxation right now is over 10 million. Most clients or donors will not fall under that. Some will and need to consider federal, but what you probably do need to consider is the Washington estate tax, which starts around 2 million. So there is a lot of gifting that can be done to lower your estate below 2 million to not be subject to what is considered one of the highest estate tax rates in the country. I would definitely have a plan if you're over 2 million, and 2 million is your taxable estate. That includes the value of your home. That includes the value of your IRA. That includes all of your assets. That's not just your investable assets being over 2 million. I believe the tax rates start at 35%, but honestly, you'd need to talk to your CPA. I am throwing a random number out there, but it is quite high. So yes, trying to gift below 2 million is a strategy that you definitely should consider in the state of Washington.
Thank you for that. A question that's come in, are there so kind of differences between how we treat cash versus appreciated stock versus in-kind gifts, and particularly limits in terms of how much appreciated stock can count as a charitable tax deduction? Karin or Doug, you're both nodding.
Yeah, I can mention that because I mentioned the 60% cash giving limitation. And so the limitation for appreciated assets is 30%. So if we go back to my $100,000 adjusted gross income example, for somebody who was giving appreciated stock, for example, I'm sorry, my dog is scratching on my door. For somebody who is giving appreciated stock, that would be a $30,000 limit this year. And then again, that can carry over for 5 years. And that appreciated asset limitation of 30% has not changed with the CARES Act. So that still remains in force.
And I would simply add the reason for that, of course, is because you get the benefit of avoiding the tax on the capital gain. And of course, just like what I mentioned earlier, you can elect to do a cost basis deduction if you want to on appreciated stock, if it makes sense for you. You talk with your CPAs about that.
You know, I want to thank all three of you for what, you know, for me was a very exciting and enjoyable panel conversation. And I really appreciate the ways in which we've explained these things. As we wrap up, I want to just highlight a couple pieces. We did advertise recipes, not just for tax savvy giving, but also for your holiday celebrations. And in a follow-up email that will come out after our time together, we'll have some of those recipes. There's a couple special ones from the PLU kitchen, including a special scone recipe, I believe, and a
correct
recipe. And then a couple other recipes from our panelists here today. And it really spans the spectrum from hot buttered rum to various vegan dishes, which hot buttered rum does not qualify as vegan at all.
No, it doesn't.
No, it doesn't. So we're excited to share those with you. I also mentioned that we recorded this webinar, and so we will share this with you in a follow-up email so you can refer it to others. And the contact info for all of the folks on this call will be included, because we find that these conversations often prompt the need to dive deeper. And so, as we've said a couple times, this is all advice we're providing, but it's not legal advice or tax advice. We do advise that you speak with your advisor, your CPA, before making any
A lot of advice.
That's
It's a
good.
lot of advice.
A lot of so,
It's a good discussion.
so I think with that, we're gonna end our call today. I want to thank again Allie for joining us from Financial Insights. If you're in need of a financial planner, you could do a lot worse than talking to the folks down at Financial Insights. So please consider that. And I will say special thanks. There's a couple of folks joining us on the call who are both alums and donors, and also philanthropic professionals. And so I hope that those folks have picked up on some good tips here as well. So thank you all for joining us, and have a wonderful
Happy Thanksgiving, everybody.
Happy Thanksgiving, everyone.
Thanks, Dan.
Thanks.